Good afternoon, everyone. A warm welcome to all the viewers of the webinar held by EAC on recent EAC opinions. Myself, CA Parul Gupta, Secretary to the Expert Advisory Committee, and today I am joined by Chairman, Expert Advisory Committee and past President, CA Dr. Devashish Mitra ji, CA Piyush Chhajarji, who is Vice Chairman, Expert Advisory Committee, and our distinguished speakers, Dr. Vinash Chandra, CA Sudhir Soni ji, and CM Mohit Viteria ji. And also our team EAC comprising of CA Khushbu Bansal and CA Preeti Lakhera. Thank you. And now I would request our Chairman EAC to give opening remarks. Thank you.
Thank you very much, Parulji, and good afternoon, everybody. My great pleasure in welcoming you to another edition of this webinar that we are having Expert Advisory Committee on various aspects, the intricate issues affecting accounts. And since last year, many of you did not know Expert Advisory Committee so much, but we have really brought Expert Advisory Committee to the forefront. And last year we had the privilege of having given 53 opinions. That was the highest given in a year since the formation of the Expert Advisory Committee in 1975. And mind you, those of us who were hearing us, watching us, all these opinions, there is hardly any dissent in all these opinions. And once the opinions are issued, we wait and watch to see whether how well the opinions have been accepted. And let me tell you, out of the 53 opinions that we had issued last year, there was hardly any opposition to the opinions that have been issued. And some of the issues involved are so intricate in nature, it becomes very, very difficult for us who are sitting in Expert Advisory Committee to take a call. And let me tell you, the Expert Advisory Committee has some of the best brains on accounting participating in this. Some of the best brains. So when you come to Expert Advisory Committee, you get the opinion of some of the best brains. In earlier times, we used to take about 5 to 6 months to give an opinion, right? Now what we are doing, we try to give the opinion within 2 to 3 months. We have almost cut down the time. It's the time that is taken to give an opinion. We almost have cut down the time. Now, this committee, the way you see it, most of the requests for opinions comes because of the CAG audit. They are mainly these PSU companies, where big ones, where you see the CAG has raised queries, and then they come to us for opinion. It's so nice of CAG that they rely so heavily on Expert Advisory Committee for its opinions. But I have always told the committee that our success will be judged by how many listed companies who have nothing to do with CAG who come to us for opinions. And let me tell you, in recent times, there have been a flow of opinions from listed companies. Right? So we are growing, doing very well. Over a period of time, we have issued more than 1,600 opinions. And those of us who are present today, if you want to know how these opinions can be accessed, then we have a search engine. Right, so use the search engine to access these opinions, and of course, we have the compendium of opinions. We have 42 volumes of the compendium of opinions. This is a treasure house of knowledge. Treasure house of knowledge, and if you go through them, you'll be surprised, amazed, and enlightened at the kind of work that this committee has done since its formation way back in 1975. Today, we are taking up 6 issues, Parul? 6 issues?
Yes.
We are taking up 6 issues today. Some of them are very intricate. Some of them are a bit easy. For example, the first issue is on the accounting treatment for late payment interest expenses in case of a new company formed for setting up of a new urea plant and is under operation phase under India's framework. Now, if you look at the first one, please note almost all the issues that we discuss now are all on India's framework. So that has been the shift. In earlier times, it will be under the AS framework. Now, everybody who comes to us post 2015, everybody who comes to us with queries, it is under India's framework. And that is where, we need to have a strong grasp over India's. Right. So, this committee is doing fantastic work. We require your support, and we require you to propound, to expound, and to tell people that such a committee is there, and you can approach this committee to see, give you opinions which are of top class nature. We have had webinars, we have had discussions, but now what the committee is doing is we are reaching out. That is, we are trying to have physical meetings. On the 17th of May in Mumbai, under the leadership of Piyush Chhajer, we are having a half-day meeting, half-day discussion on various opinions, on some of the select opinions given by expert advisory committee. So those of us who are interested in attending this, please come and attend. I'm telling you, it will be in BKC in Mumbai. We start up at 10 o'clock in the morning.
Yes.
Yeah, we start up at 10 o'clock in the morning, and some of the best speakers will be there, some of the best panel discussions. So you can also attend this physical meeting. And as we go ahead, we'll have more and more physical meetings. With these words, I wish you all a very happy learning, and thank you very much for having been part of EAC. Thank you very much for being with our side, and thank you very much for encouraging us to excel. With these words, I am handing over the proceedings to the secretary of this committee, Madam Gupta, Parul Gupta.
Thank you, sir. Now I would request our EAC Vice Chairman, CA Piyush Chhajarji, to give his address.
Thank you very much, Arun. A very good afternoon to all of you. Chairman and the past President, CA Dr. Debashish Mitra ji, CA Mohit Bhuteria ji, who is the moderator for the day, and two learned speakers, CA Avinash Chandar ji and CA Sudhir Sone ji. It's a very good afternoon to all the participants for the once again on this seminars, on this webinars which we generally have, wherein we discuss about the intricacies of India's on a particular India's topic, on a particular topic, wherein threadbare discussion happens in the EAC committee, and thereafter opinions are given. For this, we have two wonderful speakers. I would start with CA Avinash Chandarji, who has been a co-opted member of our expert advisory committee since long. He was a technical director of the institute also earlier before that, and he's very meticulous. He would not leave any stone unturned when we are discussing opinion about it, and he will always be very clear and will be forthcoming whenever his opinion is sought in this regard. CA Mohit Bhuteria ji, again, he is also a co-opted member. He would be moderating the session this time. He also contributes immensely to our expert advisory committee. This is a practicing chartered accountant coming from Kolkata. Thank you very much, Mohit ji. Thank you very much, Avinash ji. Another speaker is CA Sudhir Sone ji, who is an expert into audit and assurance himself, forming part of the one of the big four, big international, coming from Mumbai, where I belong to. Very warm welcome to you, Sudhir ji. Thank you very much for accepting our invitations. As obviously mentioned by my chairman, sir, today we will be discussing 6 topics, starting with accounting treatment for late payment interest expense in case of new company. Hereafter, there would be a discussion on timing of capitalization of the project as property, plant, and equipment. So that would be also one of the very wonderful topic and very interesting. My request to all the participants to be please attached to the screen. I'm sure it would be very helpful to all of you. Third, there would be a discussion on classification of accrued interest on short-term FDRs, flexi deposits of 3 months or less. Again, a very important topic which will be useful for day-to-day accounting, not only to the larger entities, but also to the small entities. Fourth is accounting treatment of additional capitalization arising due to arbitration award. So it would be discussing if any additional capitalization is arisen because of the dispute and there is an arbitration award, what would be the accounting treatment into it. Fifth is preparation of statement of profit and loss account in the non-revenue generating organization. Very important for non-revenue generating organizations. How do you need to actually prepare a profit and loss account? And the last one is foreign exchange fluctuation applicability in the books of the companies. So all these 3 stalwarts, 2 stalwarts who would be speaker, Mohit would be moderating it, would be discussing all these 6 topics. My request to all the members, you would have already read an opinion. but actually when you read an opinion, you would have not realized how much amount of discussion happens when these opinions are drafted. So please be attached to the screen. Please listen to these stalwarts. The thought process will get more clear when you hear them. So thank you very much once again. Thank you all the participants for joining us. Thank you, my chairman, CA Dr. Devashish Mitra. Over to you, Secretary Parulji.
Thank you, sir. Now, I would request CA Khushbu Bansal to give a formal introduction of our learned speakers. Good afternoon, everyone. I welcome all the participants to this webinar on recent EAC opinions under India's framework. And we'll be discussing some opinions issued by EAC on some of the intricate accounting issues. To discuss the opinions, we are fortunate to have some of the best minds in the field of accounting in India. Our first panelist for this session is Dr. Avinash Chandar. Dr. Avinash Chandar has approximately 50 years of vast experience relating to technical advice on various accounting principles. At present, he is a member of International Taxonomy Consultative Group of IFRS Foundation. He is director in XBRL India, special invitee on Expert Advisory Committee, Accounting Standards Board, and Committee on Public and Government Financial Management of the ICAI. He is a former technical director of ICAI and former secretary of Accounting Standards Board of ICAI. He has also been advisor to Government Accounting Standards Advisory Board, secretariat of the CADG, and various committee work groups of XBRL, International, MCA, RBI, and IRDAI. We welcome you, sir, to the today's session. Our second panelist for the day is CA Sudhir Soni. CA Sudhir Soni is the head of a leading accounting firm. He has worked as statutory auditor for large Indian and multinational companies with a vast experience of over 35 years. He has also worked on projects on accounting advisory and financial due diligence. He has sector expertise in building materials, metals and mining, retail and consumers, pharmaceuticals, agrochemicals, engineering, procurement, and construction. Currently, he is a special invitee to the Accounting Standards Board. In past, he has been part of India's Implementation Committee and Shield Panel for Excellence in Financial Reporting of the ICAI. Welcome, sir, to today's session. And to moderate the session, we have with us CA Mohit Buteria. CA Mohit Buteria is a managing partner in one of the reputed chartered accountants firm, having approximately 30 years of professional experience. He is also an insolvency professional and registered valuer. Presently, he is a co-opted member of EAC and is also associated with various other committees of ICAI in one capacity or other. He has handled more than 1,000 statutory audits of PSU, banks, and private sector corporates, and has also addressed on taxation, company law, merger, demerger, and restructuring, assurance, and non-banking finance companies issues. We welcome you all to today's session. Now I hand over the session to Mohit, sir, for taking it forward. Thank you very much and happy learning.
Thank you so much, Khushbu, for the nice introduction. Very good afternoon to all of you. Chairman EAC, Dr. Devashish Mitra, Vice Chairman Mr. Piyush Chhajed, colleagues from EAC, Parulji, Khushbuji, Preetiji, my panelists, eminent panelists Avinashji and Sudhirji. So we'll take up the first topic, first query. Just if you can allow screen share. Preetiji, yeah. So compliments to EAC for organizing such educative programs, and I think at the end of the session it would add value to each of the participants. So we start with the first query. The first case relates to accounting treatment for late payment interest expenses in case of a new company formed for setting up of new urea plant and is under operational phase under the Ind AS framework. The facts are as under. A company was incorporated for setting up of new gas-based ammonia urea complex at closed R unit of F Limited. For setting up of urea plant, the company opened its project office for execution of the project on 1st October 2015, and subsequently with the commencement of construction activities, site office was made operational. The project is being executed on EPCM, Engineering, Procurement and Construction Management route, and the project commissioned on March 2021. With initial bottlenecks, plant took some time in stabilization, and due to which losses were incurred in the first whole year of operation and it has caused scarcity of funds for the newly established company. The company has signed a gas sales agreement with G Limited for 10 years for purchase of requisite gas at prescribed rate with specified payment terms. One of the clauses of this agreement states, should either the buyer or the seller fail to make payment to the other of any sum due hereunder, defaulting party shall be liable to pay from date such payment is due until actual date of payment, interest compounded annually at the then applicable SBI marginal cost of funding based lending rates, that is the MCLR rate, as on the seller's due date or the buyer's due date, as the case may be, plus a markup of 6.25%. Later on, contract was amended with the enhancement of credit period up to 30 days and reduction in late payment interest to SBI MCLR plus 2%. During financial year 22-23, the company delayed payment to G Limited for nearly 6 to 9 months due to non-availability of funds. The company duly provided for and paid late payment charges amounting to rupees 79.88 crores during the financial year 22-23. These charges, being in the nature of finance cost, have been duly disclosed as finance cost. It has been also disclosed in the notes that this interest is payable to G Limited for late payment at SBI MCLT plus 2%. The auditor of the company, the CAG, has raised the following comments. The company has included an amount of 7987.83 lakhs under finance cost towards interest payable to G Limited at SBI MCLR plus 2% for late payment. This amount should not be included under finance cost as per guidance note on division 2 Ind AS schedule 3 of the Companies Act 2013 issued by ICAI. Further, it can be seen that a sudden huge rise of rupees 7748.24 crores, 24 lakhs, had offered in interest for delayed payment in comparison to the previous year FY22, which qualifies as an exceptional item as per Ind AS 1 and should be disclosed on the face of statement of profit and loss. Thus, it has resulted in overstatement of finance cost and understatement of other expenses by a sum of rupees 7987.83 lakhs. The query under consideration is whether presentation of expenses on account of late payment interest accounted for under finance cost as done by the company is correct or not correct. They had debited to profit and loss account. If not, what is the relevant head for its disclosure? So this is the first query. May I request Avinash ji to kindly take up this.
Thank you very much. This is a very important query. Normally, the queries are considered to be valid as applicable, keeping in view the facts and circumstances of the case. And here also, while the same consideration applies, however, this particular opinion provides guidance, very important guidance, I must say, with regard to what should be considered as an exceptional item or not. So, from that perspective, it gives a very good guidance as to what should be considered as an exceptional item and whether the interest expenses on delayed payment should be considered as a part of exceptional items or as a part of the finance cost. Now, why I am saying that this is important? Because when I was in ASB earlier, the ASB undertook a research study of about 50 nifty companies as to what types of items are disclosed as part of exceptional items. And there the ASB found that all types of items get disclosed in exceptional, under exceptional items head by the companies. Sometimes it is foreign exchange fluctuations, sometimes be considered
Recording
as
in
an
progress.
exceptional item. However, this particular opinion gives an application guidance of that uh, response which was given in an FAQ of that educational material. And from that perspective, it provides even a general guidance as to what should be considered as an exceptional item. Now, if we look at the facts of the query, the question is on the presentation of the delayed payment of interest. Delayed interest on delayed payments made to the supplier of materials. So, in other words, the question is not on recognition and measurement of interest. So, basically, the opinion restricts itself to the presentation and disclosure issues rather than going into the issues related to recognition and measurement of interest. And I may just mention, just for the guidance, general guidance of the users of the opinions, that every opinion in the first paragraph of the points considered by the committee generally includes the scope of the opinion. So when using the opinion, one should carefully go through that paragraph in which the committee generally uh, scopes out some of the issues which it has not considered, and it focuses on the issues which has been specifically raised by the querist. So therefore, in this particular case, the focus is on the presentation and disclosure of the interest paid on delayed payments rather than on their recognition and measurement. So the company in question, as it has been presented, it has been mentioned by Mohit in his presentation, they are showing it as a part of the finance cost and as other interest. And therefore, the question has arisen whether it is rightly reflected as a part of the finance cost. Now, the committee examined first that what is the nature of this interest which has been paid to the suppliers. So there, one fact which Mohitji read out, I will read once again because that lays down the nature of the interest. It says that defaulting party shall be liable to pay from the date on which payment is due to the date of actual payment at SBI MCLR rate plus earlier it was 6.25% and later on it was changed to 2%. So the committee concluded that since the amount is to be calculated on the basis of the passage of time between the due date and the date of actual payment, the interest which has been mentioned is primarily meant to compensate the time value of money. So therefore, it is basically of the nature of an interest payment only. So that was the first thing the committee examined and concluded that the amount which is payable by the company is of the nature of an interest which uh, which is primarily because of the for the compensation of time value of money. Then the committee looked into the requirements of the guidance note of the requirements of the Schedule 3 to the Companies Act. And the committee noted that the Division 2, the guidance note on Division 2 to Schedule 3 to the Companies Act, 2022 edition, it points out that in that guidance note, the interest expense is the interest cost measured at amortized cost, such as borrowings and others, calculated applying the effective interest rate. So that is the interest expense, which according to the guidance note should be reflected as a part of the finance cost under Division 2 to Schedule 3 to the Companies Act. And then in the current case also, the committee noted that the amount owed to the supplier is a financial liability under Ind AS 32 of the Ind AS 32, and it is accounted for at amortized cost under Ind AS 109 financial instruments. So under 109, initially it is measured at fair value. As you know that the initial measurement is at fair value, but subsequently it is to be measured at amortized cost using the effective interest rate, including interest on delayed payments. So here, therefore, the committee concluded that since the EIR would include the interest on delayed payments as well, thus it is a part of the finance cost. So the committee first concluded that the interest on delayed payments is a part of the finance cost. Now coming to the question of presentation as exceptional item, the committee noted that Schedule 3 to the Companies Act requires that some items may be presented as exceptional items. So now the question is that this term exceptional item, even though it is used in Schedule 3, and of course, I think in some requirements of SEBI disclosures also. However, this term has not been defined either in Schedule 3 or in Ind AS. So the question therefore is that whether this interest on delayed payment should be considered as an exceptional item or not. Now, for the purpose of presentation and disclosure, the committee looked into various requirements of Ind AS 1, because Ind AS 1 primarily relates to presentation and disclosures. So if we look at the scheme of Ind AS 1, of course, there are many requirements of Ind AS 1. So I am primarily focusing on the P&L items, which are there under Ind AS 1. So the first point to be noted is that the specific line items, other than those required in other Ind AS, have been specified in paragraph 82 of Ind AS 1. So there can be, many specific line items which are specified in other Ind AS, like for example, Ind AS 19 on employee cost. There are certain items which have been specified in paragraph 82 itself, like revenue, for example, and even finance cost. So these have been specified in paragraph 82 of Ind AS 1. Before I go further under Ind AS 1, I may just add also that Schedule 3 to the Companies Act, Division 2, also has a specific head on finance cost in the format related to profit and loss, statement of profit and loss. So both the Ind AS 1 as well as Schedule 3, they recognize that the finance cost has to be separately reflected on the face of the profit and loss account or statement of profit and loss. Then the Ind AS has further requirements. For example, paragraph 85 states that we can have additional line items apart from those which are there under paragraph 82 or which are there under other Ind AS. We can have additional line items as well when these are relevant to understanding of the financial performance of an entity. So in other words, Ind AS 1 requires that if some additional line item can be added, if it is important or if it is necessary for the understanding of the financial performance. And then paragraph 86 gives an explanation that what could be the nature of these additional line items. Now, here, paragraph 86 says that because that various activities of the entity affect the performance of the entity, they differ in frequency, potential for gain and loss, and predictability. So there are three factors which have been given in paragraph 86 that you can have an additional item. If it could be, for example, infrequent, I'm using the term myself. I mean, the word infrequent is not mentioned there in 86. There the word used is frequency. So because if the frequency of items is different, which means if the items are frequent, then everybody expects to get that it will get repeated year after year. Whereas infrequent items are not repeated year after year. So they are infrequent in nature. So they differ in frequency, potential for gain or loss, and predictability. Predictability is important in the sense that the users of the financial statements generally use the financial statements for the purpose of predicting that whether the company will do well in future or whether it will not do well in future. So therefore, if an item is expected to be repeated, then the prediction is easier to make. But if the item is not repeated and the frequency is not there, then the prediction becomes difficult, and then the users may not rely on that infrequent items for making the judgment that such an item will occur in future as well. So that is paragraph 86. Then paragraph 97 also says that when items of income or expense are material, you disclose the nature and amount separately. So this is a general requirement of para 97. And then paragraph 98 goes on to illustrate that what can be the nature of those material items. So the examples are given there, like, write down of inventories, to NRV, restructuring, I mean the expenses, restructuring expenses, disposal of PPE, investments, discontinued operations, litigation settlements, and reversal of provisions, other than impairment provisions, because that is separately given under paragraph 82. So the committee looked at all these requirements of Ind AS 1 to conclude that the exceptional items, because the committee wanted to reach a conclusion as to what could be considered as exceptional items. So the committee, relying on these paragraphs, which I have just now mentioned, they concluded that the exceptional items should be material in terms of nature and amount, and as well as the size in terms of size and incidence. Incidence means whether it will occur frequently or infrequently. So and then the committee also relied on the fact that apart from these aspects, the other two things to be considered are, number one, that if as per the scheme of Ind AS 1, paragraph 82 comes first, and there the items are specified like revenue, finance costs, etc. So if an item is falling within those specified items under paragraph 82 of Ind AS 1, or for that matter, the Schedule 3 to the Companies Act, or the other Ind AS, because paragraph 82 also recognizes that there can be separate line items to be presented under by the other Ind AS. So if the items are falling under any of the heads which are occurring under paragraph 82, schedule 3 or any other Ind AS, then you should reflect those under those heads. And if you cannot fit in under those heads, or if they are of the nature as mentioned in paragraph 98, like restructuring restructuring expenses, because they are not, they do not occur frequently. Restructuring is not a very frequent activity. Similarly, discontinued operations does not fit in any of the heads which have been mentioned in paragraph 82. So therefore, the committee concluded that to meet the test of exceptional items, the size should be material, the nature should be material, the incidence should be infrequent in nature, and then they should not fall specifically under any of the heads which have been specified in paragraph 82, or the heads, the items which have been specified in Schedule 3 to the Companies Act. So here, now applying these conclusions to the facts of the case, the committee was of the view that the interest on delayed payments, as mentioned earlier, it is a part of the finance cost. So it should be reflected because a specified head has been given in Schedule 3 as well as in paragraph 82 of Ind AS 1. It should be reflected as a part of the finance cost. However, if the amounts are material and incidence is considered, then in the notes to the accounts, you may give this interest on delayed payments as a subhead. That is, you can give a breakup of the finance cost, and in the breakup of the finance cost, in the notes to the accounts, you can reflect the amount of interest on delayed payments. So in conclusion, the committee felt that it was not an exceptional item and it is a part of the finance cost to be reflected in the notes to the, it can, of course, if it wants, it can show it the subcategories or subheads of the finance cost on the face of it if it so decide. But the finance cost can come as one line item on the face of the profit and loss, and the breakup can be given in the notes to the accounts, and it was not necessary to show the expenses, the interest on expenses on interest on delayed payments as a part of the exceptional items. So that was the conclusion which the committee reached. Thank you very much.
So therefore, just to take a clue from what you have said, Avinashji, interest would always form part of finance cost, assuming it is a PL item, and in no circumstance it can be an exceptional item, since there is a specific line item for this in Schedule 3, as you have said.
Yeah, that is what the committee concluded.
Yeah. Sudhirji, would you like to add something?
No, I think Avinash is giving a very detailed perspective. If I just give some very brief based on the experience, I think there is an inherent tension between the classification by nature that is required by Schedule 6 and the format which has been prescribed by the regulators calling out exceptional items without a definition. And therefore, this guidance which has come through the expert advisory committee is useful. And therefore, the lens of basically materiality and frequency is what should be applied. I find in experience that there is a tendency often to classify incomes within the normal course, but expenses as exceptional, and the test not being applied as rigorously. I think there will always be a judgment involved in this topic, but it's good to have a framework which we now have through the opinion.
Thank you, Sudhirji. So we come to the next case study. The next case is on the The facts of the case is as under. It is a case concerning property, plant, equipment. A company registered under Section 8 of the Companies Act as not-for-profit organization. Company is an SPV formed for development of infrastructure, which is in the nature of non-recurring, non-refundable capital grant of infrastructure works such as roads, electricity works, sewage treatment plant, solid waste management, etc. The company recorded the expenditure incurred for development of infrastructure works in capital work in progress since the work were in progress till the end of FY22. Substation, electrical works, and LED lights are the major constituents of the electrical works of the company. Work of construction of these substation and lines is being carried out by the company through turnkey contracts. The process of execution of contracts involves the following: installation of equipment at substation premises and drawing of transmission lines from one station to other are being executed by turnkey contractors under the guidance and supervision of the company engineers. The material required for these works are inspected at the works of the vendors and then dispatch instructions are issued upon confirmation of these materials meeting the technical requirements of the company. On receipt of materials at site, they are verified by the engineer in charge of the works for physical damages. State Power Transfer Corporation Limited and City Electric Supply are inspected the premises and ensured that all electrical installations in the project layout are installed and maintained as per the relevant safety codes and standards. The engineer in charge communicates about the completion of the works, commissioning, and handing over to the concerned department for use. In the instant case, the engineering department delayed to communicate commissioning of the works to the accounts branch in specific time. The details of works completed and documents submitted to the accounts department by the chief technical officer of the company at the time of submission of running account bills are as under. So here is given below a table where the particulars of work comprising of establishment of substation, electrical infrastructure, providing LED street lights to the roads of park is given, the total expenditure incurred, the date of completion report, the date of submission of final RA bill and completion report, and the date of commissioning submitted at the time of submission of the final RA bill. So it is being tabulated and available for view at the screen. The major turnkey work in the project layout is the development works for formation of roads, construction of RCC box drains and culverts, including water supply, and UGD works, which was completed on 28 February 22. The intimation about the completion was given to the accounts department only at the time of submission of final bill on 2nd May 22. Keeping in mind the project as a whole, the company's view that till all infrastructure works is completed, the expenditure for the work will be shown in capital work in progress, and thereafter the capital work in progress will be adjusted and set off with the capital grant received from state government and Government of India. Hence, in financial year 21-22, the above electrical works are shown as capital WIP. Auditor was of the view that the above includes a sum of rupees 6046.05 thousands related to establishment of substation, electrification work, and providing LED street lights to the roads of the T Park, which has already completed, commissioned, and handed over to SPTCL and SESCOM respectively. In spite of completion, commissioning, and handing over of assets to concerned user department by the company for maintenance, continuing the same under CWIP has resulted in overstatement of reserves and surplus and in progress amounting to 6046.05 thousands. Continuation of overstatement of reserves to the extent of 60.46 crores. The query for consideration is whether the auditor's observation and its suggestion to accounting treatment is right or the company's accounting treatment is right. So can I request Sudhirji to kindly share your view?
Yeah, thanks, Moji, and also thanks to the EAC for inviting me to discuss the opinions today. This topic is of extreme importance. The decision of when to capitalize an asset or a project. This is a particularly large project. This becomes a very important event normally in large companies, manufacturing companies, infrastructure companies, and so it is a topic which is highly relevant. What we notice in this query is that the CAG is pointing out that certain elements of a project are ready to use and is raised a question as to why that element is not being capitalized, although it has been handed over to the for use. I would like to point out before I go in further detail on this question is that the query has been asked under the AS framework, and this webinar is focused, of course, on the Ind AS framework. On this topic, which we will discuss, there is no difference between the requirements of the AS and Ind AS, and therefore the conclusions of the committee are equally applicable in an Ind AS framework. Coming to the topic at hand, I think there are three important issues that this opinion deals with. The first is what is the unit of measure for capitalization. The second is the what are directly attributable costs, how you deal with those. And third is this important topic which often arises in the case of capitalization of the relevance of approvals in the context of capitalizing an asset, and particularly when it takes some bit of time. So let's first come to this discussion on unit of measure. And the question is very simple. What is the unit of measure for capitalization? Is it the project or in its entirety, or is it a set of assets which are within the within that project? And to give you an example, you have the case in point, of course, here, that you are setting up an infrastructure. That infrastructure, besides, let's say, roads and bridges and some civil work, also involves some street lighting and substations and some other elements of that. And the question is that are those capable of being used for their intended purpose independently of the full infrastructure? And what I think on reading the deliberations of the committee, I think what they have done is rightly. They've pointed out that you must evaluate what is the intended use. Is it possible that the assets which are being pointed out are capable and being independently used from the rest of the project, in which case these ought to be capitalized, and therefore the consequence of that decision will be that depreciation will also commence. One of the important analogies that the deliberations picked up, whereas, as I said, the standard doesn't have a direct discussion on unit of measure, the principle they picked up from AS 16, which is also there in the corresponding Ind AS 23 on borrowing cost, is that when it comes to capitalizing borrowing cost, a similar test is prescribed. And if we can read from that, from the borrowing cost standard, para 21, it says, when the construction of a qualifying asset is completed in parts and a completed part is capable of being used while construction continues for the other parts, capitalization of borrowing cost in relation to a part should cease when substantially all the activities necessary to prepare that part for its intended use or sale are complete. So, using that principle, in this case, the committee has given a view that if some portion or some stretch of the park which is being put up with all its facilities are complete and ready for intended use while construction of remaining is being undertaken, it is possible that one component, say construction of roads, is complete and can be used independently of other components of the project. In such in such cases, the project to that extent may be considered to be in the location and condition necessary for it to be capable of operating in the manner intended by management as per the requirements of AS 10. As I mentioned, this situation in reality comes up very often in a number of industries. Let's say that you have a large industrial complex where there are two plants, one plant which produces a particular raw material which feeds into the other plant which is there. And let's say phase one of that is ready, but the intention eventually is to have the whole project together. But you start doing some transactions of sales from the first part which is already ready. So there is evidence that that plant is already ready to be used. I think, and I will soon with that come into the next phase. I think the answer on unit of measure is it depends on facts, and if there are parts which are capable of being used independently, then those should be capitalized. But the reason why often companies would like to treat entire project as a unit of measure often is the implication it may have on the accounting for the directly attributable costs, or rather for all costs which are around that project. Because the corollary of not capitalizing means that the expenses which are being incurred during that phase that you have not capitalized can be added to the cost of the asset. And there, I think, again, we need a bit of change in mindset. I think the standards are clear that they have changed. If you go back many years, there was a concept that until a project was fully completed, you almost had a concept of a basket of expenditure, and anything you incurred during that period, training, launch expenses, everything was bundled up into one basket and capitalized as indirect expenditure. Those days are gone. Today, the test of the standard is directly attributable cost, and those costs must be linked to the cost of setting up the asset. So I think that is a very important principle of the standards now. And similar thing goes in borrowing costs, that if the asset is ready, you cannot continue to capitalize borrowing cost after that point of time. And so, this often thought process that even before my project has started, I will have a loss item. There'll be an expense item which cannot be capitalized. So I think that is the principle which is being set out in this opinion. The third aspect which I would like to focus on is the importance of approvals, because here also the company put this for that approvals had not been received. And we hear this again very common in many industries, whether it is real estate projects, pharmaceutical companies where you need FDA approvals, or companies where pollution control board approvals are needed before you commence manufacture. So very often companies cite that all approvals have not been received. And so what should be the principles for that? And I think the principle that is given here in para 13 of the opinion is the company needs to determine whether the approval to be sought is substantive in a way that component or part or project cannot be considered to be in the location and condition necessary for it to be capable of operating in the manner intended by management. And they brought out a very nice distinction. In this case, the approval was relevant from the perspective of obtaining a grant. And therefore, that is not got to do with the operation of the plant or for the setting up of the plant. And so you should make that distinction as to what is the objective of the approval. Is it relating to your ability to put the plant, or is it relating to some other matters which are relating to the capitalization? And another point they made, and this is also very common, it's very often companies have a policy, we will capitalize plant when we receive certificate of completion, and that will come from our own department, civil department. In this case, the facts show that the accounts department was intimated late about the capitalization, and as the committee rightly concluded, that an internal administrative act cannot be determining when the project should be capitalized. The process should be robust so that what's happening in the economic environment is uploaded to the finance department to do the accounting for capitalization, and you can't wait for that purpose. So those were the three aspects. What is the unit of measure? What is the implication on capitalization of direct cost? And the third is the approvals. I think those are some of the important parts of this opinion that has been issued. And in conclusion, they have said, of course, it should be depending on the facts and circumstances. And if certain parts are capable of being used, then they should be considered as units of measure and capitalized.
So therefore, showing as capital advances was not correct. The conclusion is that.
I think they have hesitated from making that conclusion. But yeah, they have said, capital work in progress, but they have said that if these are capable of being used, then it should be capitalized, and therefore you cannot assume that the unit of measure is the project. So to some extent what you're saying is right.
Correct. So, would you like to add something?
No, I think Sudhir has very rightly captured the essence of the opinion, and he has also highlighted that where the errors are generally made in practice and which should be kept in mind. So I have nothing to add as such as far as this aspect is concerned. Thank you.
So we go to the next query.
Yeah.
The next query is relating to treatment of fixed deposits, short-term fixed deposits of 3 months or less. Company is a public sector undertaking under the aegis of Ministry of Housing and Urban Affairs, Government of India, established in the year 1960 as a construction arm of Government of India. The accounts for the financial year 16-17 were prepared in accordance with Ind AS along with comparatives for FY16 and opening balance as of 1st April 2015. The company presently presented investment in flexi deposit and fixed deposit having maturity 3 months or less from the date of acquisition as cash and cash equivalents along with any interest accrued on the same. The company's fixed deposit and flexi deposits are made with banks which generally provide a relaxation to the company from premature cancellation charges. Further, the amount of accrued interest is only 4.63 crores, which is only 0.28% on total cash and cash equivalents of 1652.78 crore as on March 31, 2023. Bank has paid the accrued interest in company's fixed and flexi deposit account or provided statement of accrued interest with principal amount of flexi fixed deposit. On the basis of such statement, the company accounted for the accrued interest on the flexi/fixed deposit and presented the same along with the underlying asset, that is flexi fixed deposit, having original maturity of 3 months or less under cash and cash equivalents, considering there will be no significant change in the value of cash and cash equivalents on account of premature redemption of FDR/flexi deposit. The question which arises for consideration is whether the company may continue to present accrued interest on short-term FDR/flexi deposits having original maturity of 3 months or less, along with the underlying FDR/flexi deposits under cash and cash equivalents, or any other treatment is required as per applicable accounting standards. So, Avinash, if you kindly address this query.
Yeah, it is once again an important query as to the presentation or the nature of cash and cash equivalents in the balance sheet. And without going into, the various requirements in Schedule 3 and that the cash and cash equivalents are to be separately presented. And under the bank balances also, the bank balances which are short-term in nature, other than cash and cash equivalents, they are to be presented. Those are the Schedule 3 requirements. The question primarily relates to that whether the interest accrued on these short-term investments in FD and flexi deposits, whether it should be presented in the balance sheet as a part of the cash and cash equivalents. So the committee looked into what constitute cash and cash equivalents. And for that purpose, it referred to the definition of cash and cash equivalents under Ind AS 7, which is primarily on cash flow statement. Now, under Ind AS 7, the cash and cash equivalents, you first look at the objective of the investment, that is whether the short-term investments are made or the cash, for what purpose, whether these are investment or the objective for the objective of cash and cash equivalents is to meet the short-term commitments That is primarily the objective. And then if we look at the definition of cash equivalents in India 7, it is a very important definition, which has been once again quite frequently not appropriately applied in practice. Even internationally, these issues have arisen as to what constitutes a cash and cash equivalent, keeping in view the definition of cash equivalents as given in India's 7. Now, I will therefore focus primarily on the definition as such, and then we can have a look at that how this definition, as it has been explained by the expert advisory committee, can be applied even in other situations, which are other than, of course, given in this particular facts of the case. Now, if you look at the definition is that cash equivalents are short-term, highly liquid investments that are readily converted into known amounts of cash. That is the first criteria. And second is which are subject to insignificant risk of changes in value. Of course, I may emphasize here that the definition of India 7 is not as I have mentioned. This has been given by the expert advisory committee. The definition given in India 7 is just one sentence, that these are short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to insignificant risk of changes in value. Now, the problem is that many people, they have used these criteria not as separate criteria, but they have used it as one criteria. I will try to explain a little further. Now, the first part of the definition is that these investments are readily convertible into known amounts of cash. So at the inception, that is the time when you make the investment, the amount which you will get from the investment should be known at that point of time. And known means that the amount which you will receive on maturity or when you redeem that investment, realize that investment, that amount should be known. So there is an element of certainty which is incorporated in this criterion, namely that the amount readily convertible into known amount of cash. And the second part is that which are subject to insignificant risk of changes in value. So the amount may be known, but the amount should not be subject to, the amount is subject to insignificant risk of changes in value, right? Now, where the question of, you can say, misapplication comes, that people generally believe that if there is any significant risk of change in value, for example, if the change in value is, say, 0.01% or whatever, there is an insignificant risk of changes in value, then people used to conclude that the amount is known. So in other words, the interpretation which was made in practice, that if there is an insignificant risk of change in the value, then one can conclude that the amount is known. But this opinion clarifies that these two are separate criteria and they should be looked into separately. And here I may also like to add that a similar interpretation of this definition was given. Of course, it has not been referred to by the expert advisory committee. This I am adding on my own. That a similar interpretation was given by the IFRIC in one of the agenda decisions on IAS 7, where they very clearly state that the critical criteria in the definition, I'm reading from that agenda decision, that the critical criteria in the definition of cash equivalent set out in IAS 7 are the requirements that these are convertible to known amount of cash. It is separately mentioned under inverted commas, and then again in inverted commas, that are subject to insignificant risk of change in value. And the IFRIC goes on to state the IFRIC that the first criterion means that the amount of cash will be received must be known at the time of initial investment. So they are also talking of the first criterion. So it is not that the second part of the sentence is dependent upon the first part. The first criterion means that the amount will be received must be known at the time of the initial investment. So what I am trying to say that what EAC has stated that these two components of the definition are independent criteria has been very clearly brought out, and therefore it should not be then considered that it is a part of the that you can say that if there is insignificant risk of change in value does not mean that the amount is known. So the amount must be known, that what you are to get at the time when you redeem the investment, that should be known at the inception itself. Then applying these aspects to the definition, I mean, these two criteria to the facts of the case. The first criterion is that whether the amount is convertible to cash in known amounts. So whether it is known at inception because the question is on interest accrued on these flexi deposit and the FDs which are for less than 3 months. So less than 3 months, as you know, the standard itself recognizes that these are the short-term liquid investments less than 3 months. So these would be considered as cash and cash equivalent, provided these two criteria are met. So here, the committee noted that the interest rates are fixed on the FDs as well as on flexi deposits. So therefore, the amount is known, and the amount which is accrued thereon is a part of the amount of the deposit itself, like in case of the financial assets which are measured at amortized cost. So the amortized cost includes the interest component also. So therefore, since the amount of interest is known at the inception itself, that this is the amount of interest which you will receive. So therefore, the first criterion is met, that interest rates are fixed, principal amount receivable on maturity is known at the inception. So therefore, the amount is known. Then whether there is significant risk of change in value, the second criterion, as Mohitji read out in the facts of the case, that there was an agreement with the bank that in case of the premature withdrawal of the deposit or the deposit is utilized before the term is over, then either in the facts of the case, the committee noted that either the bank waives any reduction in the interest amount or it is relaxed. So generally it was noted that the amount is waived. So there is no amount of interest is waived. I mean, penalty if there is any for early termination of the FD, that amount that penalty, if any, is not there, practically not there. So, or it is relaxed. So the committee concluded that if we look at the terms of the contract, so the terms of the contract are important to be looked into, and that aspect has been noted by the IFRIC also, that the in this case, the premature cancellation, there is not there will be insignificant change in the value of the interest, and which forms part of the deposit. So the committee concluded that this is a cash and cash. It would be appropriate to classify the accrued interest as a part of the FDs and the flexi deposits in the balance sheet as cash and cash equivalent. So that was the conclusion, and it has many practical applications, as I mentioned in the beginning itself. For example, I have practically seen in the balance sheets that you see the same. For example, I saw the ICICI Prudential overnight mutual funds, investment in mutual funds, the overnight mutual funds, which is a very short-term fund. In one case, it was classified as cash and cash equivalents, whereas in other case, it was considered as part of investments. So, of course, one has to look at the facts of the case as such. I mean, what was the objective of those investments? But I can only mention that that in similar cases, in practice, these investments, overnight investments, these have been classified differently. So perhaps this opinion can go a long way in making the presentation and the classification disclosure uniform in similar circumstances. Thank you.
Yeah. Thank you, sir. A very finer point brought about with this opinion that not only it should be convertible to known amounts of cash, but it should also be subject to insignificant risk to changes in value. And as you have rightly pointed out, relating to mutual fund, this is also a very important point. Sudhirji, would you like to add something, or shall we proceed to the next query?
No, I think we can proceed.
Yeah. Thank you. Yeah. So this is a case
Voice is also not clear.
arbitration award. The facts of the case are a company public sector at one of the integrated steel firm of T Limited and DC bid on turnkey basis at a contract value 9,82,760 plus duration of the project was 30 months from the 1st April 2011, which was delayed in 14. The delay was attributable to the contract as per terms of contract. Just a second.
Yes, sir. Yeah, please go ahead.
So is the So the contractor, the delay was attributable to the contractor, and the company demanded liquidated damages for delay as per terms of the contract. The contract did not accept the delay, Rather, they had raised various claims on account of extra work, price variation, prolonged cost and interest, etc., which could not be mutually resolved. The consortium members invoked arbitration under International Chamber of Commerce in three cases, and the arbitral award was against the company in all three cases. The arbitration amount was INR 710.99 crores plus interest till the date of payment. The arbitral award was challenged by the company in Honorable Delhi High Court in 2018 and 2019. Meanwhile, a committee of senior officials was constituted for a mutual commercial settlement. The committee held multiple rounds of discussions with the consortium of T Limited stroke DCBW. The final offer by T Limited stroke DCBV was lump sum amount of rupees 628.30 crores plus income tax on foreign services, which was considered acceptable. After approval of competent authority in February 22, a settlement agreement was signed with Messrs. Steel Limited stroke DCBV in March 22, and payment of INR 637.35 crores was made to Messrs. Steel Limited stroke DCBV under the following heads: prolonged cost including interest, balance amount as per contract, extra price variation claim, extra civil work, additional design engineering cost. The accounting treatment: after arbitration was invoked by the contractor, the claim amount of INR 962.51 crore was shown under contingent liability until the same was confirmed in March 22. On payment in March 22, prolongation cost, including interest of INR 353.41 crores, was charged to revenue in the statement of profit and loss. Item B2E amounting to 283.94 crores were capitalized. Liability for INR 153.71 crore was already existent in the books on capitalization of the asset in 2014. Balance amount of INR 130.23 crores was capitalized with effect from March 22 prospectively. The auditor's observation, CAG's observation: INR 130.23 crore, which has been capitalized in March 22, pertains to payment towards extra work and price escalation amount. Above works have already been completed before commissioning of the original asset, that is 17th October 2014. The company was getting benefits out of it since commissioning, and the amount was capitalized in the financial statements during the year 21-22 out of mutual settlement. Therefore, depreciation against capital addition agreement should have been charged from the date of initial capitalization. The management's views are as under: the asset was capitalized on 1st September 24 without considering the aforesaid claims of the contractor because the same was not contractually payable. Since the liability arises because of arbitrator's award and not because of provision of contract, the same was capitalized prospectively in accordance with the para 5A of the Appendix A. Changes in existing decommissioning, restoration, and similar liabilities to Ind AS 16 property, plant, equipment, which states that the para 5 whereof states as under: if the related asset is measured using cost model, A, subject to B, changes in the liability shall be added to or deducted from the cost of the related asset in the current period. As per para 37 of Ind AS 8 on accounting policies, changes in accounting estimates and errors, to the extent that a change in an accounting estimate gives rise to change in assets and liabilities or relates to an item of equity, it shall be recognized by adjusting the carrying amount of the relative asset, liability, or equity item in the period of the change. Accordingly, depreciation on the addition of the asset has been charged on prospective basis. The query for consideration: number one, whether the contention of the auditor that INR 130.23 crore should be depreciated retrospectively, that is from the original date of capitalization, or second, the accounting treatment of additional capitalization and depreciation followed by the company is in accordance with the requirements of Ind AS 16, Ind AS 8, and prevailing accounting policy of the company. May I request Sudhirji to kindly take up this opinion, please?
Yeah, thanks, Mohitji. And again, this is a interesting question. Very often you face these situations more in the context of large projects which are there, where eventual settlement of project cost may be much after the plant is already capitalized or commissioned. Both for this question and the earlier question, I must mention that the Institute Expert Advisory Committee has very clearly identified the focus topic to which they are responding, because the fact pattern lends itself to a lot of questions. As auditors, you pick up many different topics which might arise, but I think the focus is on the question that is being asked and not raising additional questions or peripheral questions. I just wanted to clarify that. So here, the main question that is being asked is around this additional capitalization. What is not explicitly stated in the question, but it has been analyzed, is whether the costs can be capitalized. And I think the Expert Advisory Committee looked into that aspect, and that's there in the discussion. And the second is that, having concluded that an additional cost can be capitalized, what should be the basis for depreciation? And the alternatives are, what is the CAG, what they opined is that since this pertained to an additional cost, it was only determined now, but has been in use from the day of original capitalization, it should have been depreciated from that retrospective point, if I may use those words, and charged off to the P&L as against the company's position of having capitalized it and depreciating it over the balance useful life, which may be called prospective. So those are the choices and those are the questions. So let's look at the first element as to whether these costs can be capitalized, and we go back to the same principle of directly attributable cost. And if you see, you remember the table that Mohitji presented, the first line item of prolongation of cost, including interest, that has not been proposed to be capitalized by the company. And again, rightly so, because that it doesn't have a direct linkage to the cost of setting up the asset. And so that, in fact, the company itself did not propose to capitalize. What they proposed to capitalize were the balance amounts as per the contract, extra price variation claim, extra civil work, and additional design engineering work. And in the institute has presumed, they obviously are not verifying that, but they presume in their conclusion that these are directly attributable costs. The reason why one emphasizes this, and there's a second point, and then I'll come back to that. And the second point is they also assume this does not include any new item of cost which arose after the capitalization of the asset. So I think these are two important elements of test when you are capitalizing a subsequent expenditure under this kind of fact pattern, is that are you sure it is directly attributable to the cost of setting up the asset? Because the doubt arises because of the time that has subsequently incurred. So from a fact pattern, that is something one should be careful about. And also the second is that it has not been incurred after capitalization of the asset, because subsequent expenditure after an asset is capitalized goes through, as you know, a different kind of a test. It could be repairs, it could be maintenance, it could be replacement of a component. So many different angles can come in if it was afterward, but this is nothing of that sort. This was simply on basis of a settlement that the company entered into with its vendor, additional cost that they agreed to pay for work that was done at the completion of the contract, and so it matched the criteria that it was directly attributable. Let us come to the more interesting part of this opinion, and that is the question on depreciation, that what should be the policy for depreciation. Do you go retrospective as suggested by the auditor, or do you do it prospectively? And for that, we go to another standard actually, which is the standard on accounting policies, changes in accounting estimates, and errors. Now, this determination of arbitration claim could not have been predicted at the point this was done, or maybe there was a different estimate of the outcome that was made, and so it is not in the nature of an error. The reason I emphasize that is, in most principles as per Ind AS 8, if you determine that there has been an error, then you would do retrospective accounting. But the fact pattern here suggests that this is a change in an accounting estimate, and therefore your accounting conclusions should be driven by a change in accounting estimate. And there the company has referred, and the EAC also has referred to para 37 of Ind AS 8, which says that to the extent that a change in an accounting estimate gives rise to changes in assets and liabilities or relates to an item of equity, it shall be recognized by adjusting the carrying amount of the related asset. So we are so far good to say that yes, this relates to change in the value of an asset, and so it should be capitalized to the asset. The general principle under Ind AS 8 is that if there are accounting estimate changes, then they are dealt with prospectively. And there are a couple of analogies to that. So for example, if you change the useful life of an asset, which is an accounting estimate, then the standard is very clear that that should be done prospectively. Nowadays, even if there is a change in the method of depreciation, that is also treated as a change in an estimate. Again, I say now because a gap evolves. If you go back a few years, change in method had to be given effect retrospectively. That is now no longer the case. If you have a change in method of depreciating, even then you change it prospectively. And the same conclusion has been drawn in this case, that the amount that is being capitalized now, that should be depreciated prospectively over the balance useful life of the asset. Let me tell you that there is a strong economic argument to say that, look, you already utilized part of this value from the date it originally capitalized till today when you are booking this amount, and there has been no physical change to the asset. You're only booking an additional amount, and therefore there is a certain economic logic to saying why you shouldn't expense retrospectively everything in the current year, because there is a loss of value and maybe exceptional by some stretch. But I think the direction of the accounting literature now is that where there's a change in an accounting estimate, then it is treated prospectively. These changes or the effect of that is treated prospectively. And it is on that basis that the EAC concluded that this should be prospective. Now, the one risk that arises is that do we have a risk that we end up with overcapitalizing? Let us say that we capitalize today this amount and we only have 2 or 3 years left of the useful life of the asset. Then are we carrying a value very high? And there in the discussion, the expert advisory committee has rightfully pointed out that it should also be reviewed for impairment under Ind AS 36. And so that becomes a kind of check to the fact that you're not carrying a higher value of the asset than it is recoverable. So I think that is how the conclusion is, in my view, well made out by the expert advisory committee.
Thank you so much, Sudhirji. Very well drawn out. The one other point that even if you do a change in the method of depreciation, that has to not be done retrospectively, but now prospectively, what you said. Avinashji, would you like to add something?
No, I don't have anything to say. We can go to the next one.
Okay, thank you. So we take up the next query. So this is relating to preparation of a financial statement of a non-revenue generating organization. The facts of the case are as a corporation, a special purpose vehicle was incorporated for execution of East-West Metro Corridor project in one of the metro cities. The revenue services are undertaken by Metro Rail of the city, which will in charge of operation and maintenance of the system. Hence, no revenue is earned by the corporation. The statement of profit and loss used to be prepared since the inception of the enterprise, which mainly constituted of expenses such as employee benefit expenses, depreciation and amortization expenses, and other administrative expenses such as repairs and maintenance, audit fees, foreign exchange fluctuation cost, etc. All other expenses relating to the project are being capitalized. As the enterprise does not generate any revenue, this resulted in portraying the enterprise as a loss-making one, which is not the case. As for the queries, for the corporation not being a revenue-generating one, the question of making either profit or loss does not arise. Hence, for financial year ended FY 2021, it was decided to do away with the statement of profit-loss. Auditor commented on the accounts of the corporation for FY 21 that unless expenses are directly attributable to the construction of the project, those should be expensed in the statement of profit and loss. The corporation is an SPV and has a single project, East-West Metro Corridor project. Hence, as per the company, all the expenses are directly related to this single project. Whatever legal fees are expended are directly related to arbitration cases in course of execution of this project. Auditors' fees are being paid for audit of this single project, and so are the director sitting fees. A letter from Ministry of Railways, Railway Board, Government of India has instructed that interest earned on the funds released by the MOR/GOM/zonal railways lying surplus till their actual utilization shall not be treated as surpluses stroke profits of the company. Interest amount on funds shall be credited to the projects for which these funds have been released. Another letter from the Ministry of Railways states that as per the Cabinet's approval, after the completion of execution of the project, Metro Railway would run the East-West Metro Corridor. The query for consideration is whether the preparation of statement of profit and loss account is required in the current scenario or can be done away with. So may I request Avinashji to kindly take up this query?
Yeah, thank you. Actually, this, to my mind, is a simple case. But it contains some important lessons that, whether a company which is at construction stage, whether it should prepare a profit and loss account. Now, if we, some time back, the institute used to have one guidance note on expenditure during construction period, which was later withdrawn. So in that guidance note, there used to be one recommendation that during the construction stage, you, instead of preparing the profit and loss account, you can prepare a statement of expenditure during construction account. So there was some sort of relaxation available under that guidance note that you need not prepare a statement of profit and loss. But as I mentioned, that guidance note has long been withdrawn. Even under the AS framework, that guidance does not exist. Now, as I mentioned, and Sudhir also mentioned in the context of an earlier opinion, that generally, what happens in practice sometimes, that during construction stage, companies tend to capitalize all types of expenditure which is incurred as a part of the cost of the project as such. So therefore, possibly in this case also, there was, of course, in the initial stage, the company was preparing statement of profit and loss, but for some reason it decided to discontinue. Possibly the reason could have been that, okay, if we are at the construction stage, then whatever expenses we are incurring, they will go into the project cost because it is a single project company. There is no other project being carried on. So during construction stage, there is no necessity to prepare a statement of profit and loss. The committee has also discussed this aspect, that, and it is very categorically stated by the company, which should be noted by everyone, that it is not necessary that all costs incurred during construction are eligible for capitalization. Just because there is only one single activity being the construction of a project does not mean that every expense is directly attributable to the assets being constructed. So this is an important statement which the opinion contains, that directly attributable to the assets is something different than what is to be presumed that during construction stage, because there is no other activity being carried on, all expenses are directly attributable to the project. So the committee goes on to state that the capitalization depends on the nature of expenses in relation to the construction of the asset as such. And these principles have been laid down in the relevant Ind AS. For example, with regard to property, plant, and equipment, the principle of capitalization have been laid down under Ind AS 16. And therefore, Ind AS 16 should be looked into what type of expenses can be capitalized, what are considered as directly attributable to the construction of the asset as such. Now, you may recall that some time back, even the foreign currency exchange loss used to be capitalized. In Schedule 6, earlier Schedule 6 used to give some guidance. And even under Ind AS, in Ind AS 101, for the the foreign exchange loans which are outstanding at the time when Ind AS were introduced. So because of AS 22, para 46, 46A, you may continue to capitalize that. But that was, a kind of a relaxation which was given at the inception of the Ind AS. But today, if there is a foreign currency loan, for example, in a construction contract, that foreign exchange losses cannot be capitalized unless, of course, they are covered in Ind AS 23 in paragraph 6E to the extent of, the difference in the interest rates, the local interest rates and the rates at which the foreign exchange loans are raised. So therefore, the one has, of course, this example is not given in the opinion. I am just adding on my own that earlier every foreign exchange loss used to be capitalized, irrespective of whether it is covered in Ind AS 23 or AS 16. But now it is subject to the requirements of Ind AS 23, AS 16. I just highlighted this example to illustrate the impact of the opinion which the EAC has given, that not all expenses are eligible to be capitalized. You look at the individual standards and then apply the principles which are enshrined therein. Now, coming to the preparation of the profit and loss account, the committee looked at the requirements of the Companies Act 2013 regarding preparation of profit and loss account. And in the committee looked at section 129(2), that at every AGM, the board of directors lay before the meeting the financial statements for the financial year. And so it is necessary that these financial statements are to be presented under section 122 to the board of directors. And then the committee looked at, because the term used in section 129(2) is the financial statement. So they looked at the definition of financial statements under section 2, subsection 40. And it is noted that the term financial statements include the profit and loss account. So the profit and loss account has also to be included or to be presented for the board's approval under, in the AGM for 129(2). Then paragraph, the committee also looked at that paragraph 10 of Ind AS 1 also include the statement of profit and loss as one of the financial statements as a part of the complete set of financial statements. So in other words, the committee noted that neither the Companies Act nor the Ind AS provide any kind of exemption from the preparation of the statement of profit and loss. And therefore, the committee also noted that simply because the company is not generating any revenue does not mean that you don't prepare a profit or loss. The company during the construction period incurs expenses which are not eligible for capitalization, such as I gave you the example of foreign exchange fluctuation, foreign exchange loss, or audit fees and share issue expenses, which are to be governed by the relevant standards. And therefore, simply because revenue is not being generated during construction period is not a ground for not preparing the statement of profit and loss. And therefore, the committee concluded that since the company may reflect, even if the company may reflect loss during the construction period, that does not mean that there is an exemption from the preparation of statement of profit and loss. And in conclusion, the committee categorically stated that that a construction stage enterprise must also prepare a statement of profit and loss. And therefore, now there is no ambiguity in terms of whether there can be any exemption from preparing the statement of profit and loss as such. So that is the conclusion which the EAC categorically reached. And now, obviously, one cannot, it's very surprising that the company in this particular case started off preparing P&L and then discontinued and then raised this issue. So one can only summarize as to why they discontinued or not. Possibly they didn't want to reflect the losses during construction stage and things like that. But the EAC was quite clear in its mind that even if there are losses reflected during construction phase, that there are no revenues, etc., the company must, every company now, therefore, will have to prepare statement of profit and loss, no exemption whatsoever. Thank you.
That's a very important point brought out, that it is mandatory for all companies, irrespective whether they have commenced operations or not, to prepare a statement of profit and loss. Yeah. Sir, Sudhirji, would you like to add anything?
No, I fully agree with I think all the comments Avinashji made and the rationale for why the profit and loss should be prepared. Most likely there will be activities, as he explained, number of examples where you'll have a charge to profit and loss even in a construction based activity. There's one interesting topic I'll just leave for the our participants today in this context. We had an interesting discussion on directly attributable expense, and all the issues that we dealt with was this question of proceeds from sales of products which were manufactured during during the construction period. At times you're testing a facility and you're using it, and we I think after good consideration and deliberation, we I think have a departure from IFRS over there in Ind AS. And so for your academic interest, you may want to look at this topic, whereas in IFRS they prohibited the adjustment of these revenues from the cost of capitalization or from directly attributable expenses. In India, we felt convinced that it possibly is the right thing to do, and our standards are accordingly maintaining, and some minor amendments made, but in the direction to say that you can net off such a cost. So since this was a whole topic around capitalization, I thought it'd be relevant to mention.
I think we have also an opinion just recently given on this subject by the EAC as well.
Okay.
So we come to the next query on foreign exchange fluctuation. So the facts of the case are the company was incorporated with equal equity participation from Government of India and the state government under a SPV for implementation and operation of metro rail project in a state. With regard to project funding of phase 1 and phase 1 extension of metro rail project, Government of India, in addition to provision of equity capital and subordinate debt, funds project by means of borrowed funds from multilateral/bilateral funding agencies such as Overseas Development Assistance. The said ODA loan agreement is signed between Government of India and the multilateral/bilateral funding agency in foreign currency. Loan along with interest is to be repaid by Government of India in foreign currency. Loan is for a tenure of 30 years, which includes a moratorium period of 10 years, and interest on the loan is around 1.2 to 1.4% per annum. With respect to procedure for flow of funds, company receives the amount from Government of India in terms of INR as a pass-through assistance. Subsequently, company on utilization of the said pass-through assistance amount submits its claim to the multilateral/bilateral funding agency, and the multilateral/bilateral funding agency releases the payment to controller of aids accounts and audit. Based on the information from the controller of AIDS accounts and audit, company adjusts the pass-through amount received from Government of India to loan from multilateral stroke bilateral funding agency. The company has adopted Ind AS with effect from 1st April 16. Company being a government company carrying on infrastructure projects has adopted Ind AS in compliance of law. As per present accounting policy of the company, it does not follow Ind AS 21 as it accounts for its liability only in Indian rupees as it receives funds from Government of India in INR as pass-through assistance. So the company was of the view that the loan agreement is between Government of India and the multilateral stroke bilateral funding agencies, and all the amounts are received in INR from Government of India. Foreign exchange fluctuation is not required to be accounted for in the books of the company. The MOU between Government of India, state government, and the company for phase 1 was signed in 2011 when the Forex computation and accounting was different as per applicable accounting standard at that point of time. As per clause 14.16 of phase 1 MOU, the debt servicing liability of the company with regard to the multilateral stroke bilateral funding agency loan portion shall be reckoned based on the multilateral stroke bilateral funding agency's repayment schedule received from the multilateral stroke bilateral funding agency in rupee terms along with exchange rate fluctuation of loan currency. As per clause 14.17 of phase 1 extension MOU, debt servicing liability of the company with regard to the multilateral stroke bilateral funding agency loan portion shall be reckoned based on the multilateral stroke bilateral loan repayment schedule received from the multilateral stroke bilateral funding agency in terms of rupees. From MOUs, it is quite evident that while signing MOU for phase 1 extension, Forex fluctuation impact was suitably excluded compared to MOU of phase 1, keeping in view the requirements under Ind AS. The company also informed that one of the clause of MOU refers to the obligation of state government for overall foreign exchange fluctuation, whereas another clause specifically refers to the inclusion of Forex fluctuations on GICA loan in debt servicing liability of the company. The GFR 2017 are applicable to all central government ministries, stroke departments, and its subordinate bodies. Since the Ministry of Finance, to which the loan is sanctioned, comes under the central government Ministry of India, and as per Rule 273, Government of India will recognize foreign exchange variations once loan is fully paid and not during the loan tenure, and such accounting of exchange variation shall be adjusted stroke written off to miscellaneous government accounts, which gives a tactic reference that foreign fluctuation is Government of India's accounts. Considering exchange rate movements and the resultant changes in the balance sheet and statement of profit and loss, the exchange variation clause is taken off in phase 1 extension MOU. The company has at no point of time received loan in any foreign currency nor repaid interest stroke principal in foreign currency. The qualifications of the statutory auditors relating to Ind AS 21, foreign currency assets and liabilities are to be valued on the balance sheet date by translating using closing rate as per para 23 of Ind AS, which has not been carried out by the company regarding the multilateral stroke bilateral funding agency loan. Ind AS 23, the exchange difference arising from foreign currency borrowings that have to be regarded as interest costs under Ind AS paragraph 6C were not determined. The borrowing costs eligible for capitalization on qualifying assets have not been determined accordingly. The company informed that it is not able to meet the operational cash flow requirement. For the past 4 years since its inception of operation, it has continued to report huge losses, and the same trend may continue for the next couple of years. In these scenarios, the state government has to make repayment of principal and interest, including the exchange variation, if any. For repayment of loan and interest, the company is primarily looking for support from the government. Hence, when the entire transaction of loan is happening outside the books of the company, accounting for forex fluctuations on estimated basis will neither add any value to the company nor seems technically proper and just. As per accounting requirements, the exchange impact has to be added, stroke deducted from the value of the assets. As forex rates will undergo change in each accounting period, the asset value will also undergo changes at each reporting period, which will not reflect the actual cost of asset and its depreciation. The question arises for consideration. whether to include stroke exclude the forex fluctuation impact in the books of the companies under the following two circumstances. First, when the loan and interest are directly paid by the government of India stroke state government. Second, when the loan and interest are paid by the company in rupee terms to government for onward payment to funding agencies. So may I request Sudhirji to kindly take up this query?
Yeah, sure. Thanks. So I think briefly stated, there are two projects or two contracts here. There's an MOU of 2011, which is called Phase 1. And there is an MOU of 2017, which is called Phase 1 Extension. And in the MOU on Phase 1, the 2011 MOU, it is explicitly stated that the company will have the entire liability for the loan interest and also for the exchange fluctuation. In the 2017 MOU for the other part of the project, which is called Phase 1 Extension, this explicit mention is not there, or rather it has been deleted, and it is in that background that the opinion is being sought. So I'll read out the relevant paragraph from Ind AS 21, which is cited by the Expert Advisory Committee in making its decision. And this is para 20, which states that a foreign currency transaction is a transaction that is denominated or requires settlement in a foreign currency, including transactions arising when an entity borrows or lends funds when the amounts payable or receivable are denominated in foreign currency. Now, I think those are the important words, that it is denominated in foreign currency. It is not necessary that the company should be directly transacting in the foreign currency. And I can tell you that these are fairly common, even on both revenue and capital account. Very often contracts are entered into where the pricing, so you're doing a transaction in India, but you know that the global pricing is done in dollars. And so at times you may enter into your contract where you're transacting physically in rupees, but actually it is linked to, let's say, a dollar value. And here the Expert Advisory Committee has therefore concluded that these are denominated where. So for the Phase 1, which is 2011 MOU, they're very clear that the company should do the foreign currency accounting, make the necessary translation. And for the Phase 2, based on the contract, it appears that it is not required to be done. And it depends on the facts. If it is clear that the foreign currency fluctuation will be borne by the government or the other, the agencies through whom the funding is being obtained, then you need not account for that. So I think that is the basic principle, that if it is denominated in foreign currency, you should still treat it like a foreign currency transaction. I think it's again very important and useful opinion that we have over here.
Thank you, Sudhirji. Yeah. Avinashji, would you like to add anything?
Nothing specific. I think earlier also a similar question was raised that, if a company doesn't have exposure to foreign exchange risk at all, because if the risk is passed on to someone else, whether the whether you apply Ind AS, I mean, at that time, of course, it was not Ind AS 21, it was AS 11. So there also, the committee had earlier a point that if there is a monetary asset or a liability which is denominated in foreign currency, then you must apply AS 11. So the same principle is that if the foreign exchange loans, etc., are denominated in foreign currency, you apply the Ind AS 21. It is the same principle, I think. So
we have a brief question, if I may speak. In case of an integrated project, Sudhir sir, we were dealing with the PP query. In case of an integrated project, if one of the asset stroke part involved is ready and can be used independently of the project, but has not been put to use, should that part be capitalized and depreciation should commence on that part?
Yeah, I think if it is a part which is capable of being used, in that case, it should be capitalized and depreciated from there on.
Because I think the criteria, it should be ready for use.
It should be ready, yeah. That
Yeah.
should be ready for use.
Yeah.
Yeah.
So, Parulji, if you have any questions from the participants,
No, sir. No other relevant questions. Now, Preeti Lakhera would give the closing remarks.
Thank you, ma'am. Thank you all the participants for joining today's webinar. We appreciate your time and engagement. We want to extend our gratitude to the speakers of the webinar, Dr. Avinash Chandar, CA Sudhir Soni, and CA Mohit Bhuteria for steering today's webinar. The views expressed in the panel discussion were insightful and gave guidance on many relevant issues. The opinions discussed are quite relevant to almost all the entities, although these are facts and case specific. They explain important principles of the standards. We believe that the deliberation and the panel discussion will be of immense help to the participants, and we assure to give the benefit of EAC expertise in future as well. Thank you so much.
Thank you. Thank you.
thank you.
Thank you.
Thank you, sir.
Thank you.
Tech support, you may stop the recording.